So we're going to be moving into the next paper a few minutes ahead of time. We have Chang presenting international equity and debt flows to emerging market countries, composition, crisis, and controls.
Okay. Thank you for having this paper, Chang from Fudan University. This paper is a joint work with Professor Shang-Jin from Columbia University, who is also here. Now, let me give you a motivation on this paper. We know that capital flows to emerging markets are very volatile. This is problematic because oftentimes it contributes to a balance payment or debt crisis in those capital recipient countries and lead to very volatile consumption. Therefore, there exists a case for countries to regulate capital flows and impose capital controls so as to resume financial stability and efficiency. But theoretically, why do we think countries should impose capital controls? Well, existing literature offers two stories. The first one is based on pecuniary externality. That is due to the existence of an occasionally binding collateral borrowing constraint. And the second one is based on aggregate demand externality. That is due to the existence of fixed exchange rate regimes plus price or wage rigidity. In both stories, private borrowing in competitive equilibrium displays inefficiency. That means it differs from a socially optimal level. Therefore, countries have a case to impose capital controls to correct such externality. But a common feature in those two stories is that there's only debt flows. Now, in this paper, one important point of departure is that debt is not the only form of international capital flows, and we also have equity flows, portfolio equity plus FDI. And importantly, equity provides much better risk sharing for these capital recipient countries. Therefore, in this paper, we're gonna work out a model to embed a role for both equity and debt to study the implications for existing literature. But our starting point is really motivated from empirical facts, which is a relationship I show you here. And later, I'm going to show you a bunch of sets of rigorous empirical specifications. Now here on the x-axis, you have a measure for a country's institutional quality measure. A higher number means a better institutional quality. That is less country-level corruption, better rule of law, better protection for international investors. On the y-axis, you have a share of equity, FDI plus portfolio equity in total external liability. That is a safer external capital structure to the extent equity provides better risk sharing. Now, in the data, you can see cross-countryly, we have observed countries with a better institutional quality measure also have a higher share of equity in total external liability. That is safer external capital structure. And also later, I'm showing you that countries also gonna experience less frequent financial crisis, therefore less inefficiency and less need for capital controls. Now, those sets of empirical work really motivate us to work out a theory to rationalize the salient features of the data. And in particular, we're gonna allow both equity and debt and highlight the role of domestic institutional quality in determining this composition. And based on that framework, we're gonna work out the optimal capital controls. Now, in addition to the theoretical facts, in addition to the empirical facts and the theoretical findings in our paper are as follows. Now, number one, we're gonna argue that capital structure and financial stability gonna depend on institutional quality. And institutional quality is very important for us to understand the difference between emerging versus advanced countries. And in particular, we're gonna highlight improving institutional qualities and relaxing financial constraints are not the same thing. And in the previous literature, people oftentimes think the difference between advanced versus emerging market economy lies in relaxing financial constraints. And we will show you that's not the same thing. Now, second point is that optimal capital controls policy also going to depend on institutional quality. Importantly, improving institutional quality is better than imposing capital controls in terms of resuming financial stability and improve efficiency. But when countries cannot improve institutional quality in the short run, capital controls policy is still useful. But because you have debt and equity flows, you're going to differentially regulate them. And in particular, the tax rate on debt will be larger than the tax rate on equity. And this insight will be consistent with Anton's work. Now, this view through institutional quality also can help us understand other different types of flows in the international capital market. For example, in the extension, we're going to show you it helps us to understand FDI versus passive equity financing, local currency debt relative to foreign currency debt, long-term versus short-term debt. Now, let me start by showing you some data patterns, which I just briefly touched, and I'm going to run a bunch of regressions. Now, the data we have is for 159 countries between 1996 and 2015. We're going to show you 3 sets of empirical results. The first one is consistent with the graph you just see before. Countries with better institutional quality also have a higher share of equity financing. And this is also true even after we control for income, trade, and domestic financial development. Second, when a country has a higher share of equity financing, it is indeed safe in the sense that financial crises will be less frequent. Third, for countries with a lower quality of institutions, those countries also have more restrictions on capital flows, both equity and debt flows. Now, the first set of results, we're going to run both panel regression and long difference in the cross-sectional regression. And in either specifications, you can see that countries with a higher institutional quality tend to have a higher equity share. The second set of results, a higher share in equity in total external liability predicts a lower frequency of financial crises, be it sudden stop crisis or systemic banking crisis. 3, when countries have a higher institutional quality measure, it also predicts these countries tend to restrict less on both equity and debt flows, conditional on other things. And this relationship holds in various of the empirical specifications. Now, with these empirical facts in mind, we are going to work out a model to rationalize this pattern and highlight the role for domestic institutional quality. Our starting point is a standard model in pecuniary externality literature. We're going to have a small open economy, 3-period model. We have tradable and non-tradable good, and the household are going to have a preference in logs, and we only allow non-tradable good to enter in the second period, but this is not a strict assumption. We can relax it. The income stream is as follows. In the first period, you do not have income, which generates a motive to borrow. In the second period, you have tradable and non-tradable income. And in the third period, you only have tradable income. The only source of risk in this model comes from the tradable income shock. Now, in this economy, in the first period, because you don't have income, and we allow the household to issue either debt and equity contract. The debt contract is standard in the literature. It's denominated in the units of tradable good, 1-period debt. And in extensions, we work out the variations in long-term debt and local currency debt. The equity contract is the first deviation from the previous literature. We allow agent to sell the equity contract. That's a claim on the tradable income stream in the future. In the benchmark model, we do not embed a role for control right, but in an extension, we will distinguish between FDI versus passive portfolio equity. Now, after issuing the debt in the first period, in the second period, the agent can also issue additional debt contract. And here, we are going to follow the literature and assume financial frictions in the debt market. And it says the amount of money you can borrow cannot exceed a fraction fee of your total income. The fee parameter is an important parameter in the previous literature to capture the difference between advanced and emerging market economy. That is the degree of financial friction, meaning how many of your income can be pledgeable to the international investors. We're going to show you it's not as important as institutional quality measure. The price of a non-tradable good enters into the collateral constraint. That's going to generate a pecuniary externality. That's going to be consistent with the previous literature. Now, what is the role of institutional quality? Well, to have that, we're going to provide a macro foundation to think about that. Although we're going to have an endowment economy, we're going to introduce additional agent to allow the asymmetric information so that institutional quality can matter. In particular, domestic firms managed by a CEO can observe the tradable income shock, where international investors cannot. Therefore, in each period, the CEO can potentially steal a fraction of the payoffs from the equity investors. Of course, the investors can bring the CEO into domestic court. But depending on the institutional quality, there will be a chance the CEO will lose in the case and therefore suffer loss. And similar argument can apply to both debt and equity contract. But importantly, because that contract promises you a payment that is stated uncontingent, stated incontingent, invariant, therefore the CEO have to incur a larger cost to manipulate the debt contract. That is to forcefully declare bankruptcy. And in the model, we're going to assume the bankruptcy cost is big enough such that CEO never cheats on debt. But the decision to cheat or not is going to depend on the expected payoff from cheating. We, in the end, are going to depend on how much the CEO is going to be caught, how likely he will have to pay the fine, and also how much fraction he can steal. And therefore, you can imagine the expected payoff is going to be an important parameter. Indeed, with this macro foundation in mind, we're going to put all these variables into a sufficient statistical measure, theta. That is the expected payoff for CEO to steal this money on either equity or debt financing. And theta is also related to the measure of institutional quality. In particular, when the country protects the international investor better, you're going to have a lower theta. Now, with this institutional quality measure, we can solve this model in terms of capital structure and determine how much capital controls policy you want to impose. Now, all these insights will be summarized in this graph. As you can see, depending on where you are in terms of institutional quality measure, when this country have a so good institutional quality, the equity financing will be relatively cheap. Therefore, this country would like to issue equity as much as possible. But when institutional quality declines, you have to rely on debt. And in the extreme case, it will be not optimal to issue any equity in equilibrium. Then we are going back to the case with previous literature where you only have debt flows. And moreover, this capital structure also implies the financial stability and the case for capital controls. With more and more debt in hand, you are more likely to run into financial crises. Because crises are inefficient, you also want to regulate the capital controls. Therefore, all these endogenous variables are going to move along with the institutional quality measure, and it's going to be consistent with the empirical facts 3 that I presented before. And in this model, we can also work out theoretically, analytically, what the tax rate would be. In particular, it depends on institutional quality. Also, the tax rate on debt will be larger than equity. Okay, I only have a few minutes left. Let me stress the meat of this paper, the other additional insight, which is that to understand the cross-country difference in terms of advanced country versus emerging market economy, we're going to argue it's more important to understand the institutional quality measure as opposed to the financial development measure fee. Why is that? Now, let's think about the case. Relative to the emerging market economies, advanced economies typically have better institutional quality and a higher level of financial development. That is a lower theta and higher fee. Now we're going to see whether our model can generate data patterns consistent, model implied patterns consistent with data. We do so by comparative statistics by varying theta and phi. Now, indeed, these two parameters implies a similar prediction on the probability of crisis. And lower theta and high phi both implies a low probability. But lower theta in terms of better institutional quality implies a higher share of equity financing, lower intensity of capital controls. That's consistent with the data. However, a higher fee with a higher financial development in this model predicts the opposite pattern. Therefore, we conclude by this exercise, it's more important to understand institutional quality differences as opposed to financial development to understand the difference between advanced and emerging market economies. Now, in the interest of time, let me conclude. We start from empirical facts to work out a model of composition of capital flows and to embed the role of institutional quality. We show you that institutional quality determines its capital structure, financing stability, and capital controls. Also, we highlight it's more important to understand the institutional quality differences cross-country. Okay, thank you very much.
Thank you, Chang. We have Anton Korinek discussing.
Thank you, Alessandro, and thank you very much to the organizers for giving me the opportunity to discuss this really interesting paper. So let me perhaps start with a quick summary of what Chang and Shang-Jin are doing. The paper provides a theory of countries' external capital structure, based basically on a notion that is very familiar from corporate finance, that equity generates greater moral hazard than debt. Equity makes it easier to steal, essentially, from your claim holders than debt. Based on the observation that greater institutional quality counteracts these moral hazard incentives. So the implications of that are threefold. More developed countries use more equity because moral hazard is not as big there, and are by implication better insured. Now, this implies that they have fewer crises, and as a result, they also have less need for capital controls. So I will provide a bunch of high-level comments on the paper during my discussion now. Chang and we are going to speak on Wednesday, and I will provide my most extensive comments there. Let me start with a little bit of background on pecuniary externalities. These pecuniary externalities, they essentially arise whenever financial markets are incomplete. And in fact, there's two types of pecuniary externalities that we could be worried about. One is distributive externalities, which happen when agents are imperfectly insured and when price movements change agents' terms of trade. So when they're imperfectly insured, having better terms of trade in bad states and worse terms of trade in good states can essentially make up for insurance. I mentioned that because there is a paper in the literature that looks at a question very similar. Caballero and Krishnamurti in 2003 look essentially at financial development and underinsurance, and they base their findings on these distributive externalities. Now, in this paper, Chang and Shang-Jin are using a slightly different pecuniary externality, one that the literature often calls a collateral externalities. So these collateral externalities arise when agents are subject to price-dependent financial constraints. Essentially, there is an exchange rate that enters the financial constraint. Private agents take that as a given, and as a result of that, they do not recognize that their financing choices affect how severe financial amplification will be, and that gives rise to these feedback loops that I guess we are all extremely familiar with from the literature. So essentially, when you have capital outflows beyond a certain threshold, your exchange rate is going to fall. That means your collateral value declines further. Your borrowing capacity is even more curtailed and forces you to export even more capital because your constraint is tighter. That means exchange rates fall even more, and you have this feedback loop that gets on and on and on and on. Now, what can we do in the face of these collateral externalities? Let me try to illustrate this essentially in a simple demand and supply diagram. So the simpler curve is the supply curve, which is from international investors and which is simply perfectly elastic. If we look now at the case of a specific security, so I have illustrated it for the case of debt in these two graphs. And our domestic agents have an elastic demand curve. I have depicted it as here the demand curve that prevails the competitive equilibrium between periods 1 and 2. So they choose how much to borrow in period 1 and to repay in period 2. The second graph, it should say between periods 2 and 3, is when a financial constraint may be binding. And I have illustrated the financial constraint by these vertical lines that I'm moving my cursor over here. So essentially, what a private agent feels is the private agent thinks she can simply equate her marginal utilities in periods 1 and 2. And then in period 2, there's suddenly this binding constraint that she takes as a given because she's a price taker. And in general equilibrium, the constraint depends on that price, but an individual agent cannot do anything about that. However, the planner recognizes that if she borrows a little bit less in the initial period, period 1 here, then there will be more funds available in period 2, less reason to engage in capital outflows in period 2. And that means the exchange rate will be less depreciated, and the financial constraints essentially shifts outwards from D prime competitive equilibrium to D prime social planner. What we can see is if we relax a binding constraint here in period 2, that provides us with a first order gain, whereas borrowing a little bit less here in period 1 on the left-hand side diagram only introduces a second order loss. So that means we are in the realm of the classical example of a second best intervention, second order distortion in the period in which we intervene with capital controls, first order gain in those future states of nature where there is a binding constraint, and that means there's an unambiguous welfare gain. So this is the basic intuition. Now, what I do want to emphasize, whenever we have a richer capital structure, and I will talk about the example of a complete set of state contingent securities between the period before the constraint binds and the period when the constraint happens, then we do have in the existing literature an existing set of results for how to express the optimal tax interventions in such a case. So essentially, if we apply this basic picture that I have shown you on the previous slide to a setting in which there's multiple states of nature, constraints are typically the tightest in the bad states of nature. Now, we know in bad states of nature, equity repays less than debt. So that tells us immediately that equity will have smaller externalities. The general tax formula for state contingent securities, whether that is equity or debt, for how to impose these capital controls or taxes against pecuniary externalities is in some sense very much akin to a standard asset pricing equation. So in standard asset pricing, we determine the price of a security as the expectation of some pricing kernel times the vector of state contingent payoffs. Here I'm denoting the vector of state contingent payoffs or the state contingent payoff by x omega for state of nature omega. We can essentially find a very similar formula to obtain optimal taxes that a planner would impose on state contingent securities. And then we use, instead of a pricing kernel, which is usually denoted by m omega, we can use what the literature calls an externality kernel, tau omega. And the optimal tax on any security, simply the expectation of this externality kernel, tau omega, times the vector of state contingent payoffs x omega. And that gives us essentially the analog of a standard asset pricing formula. Now, in fact, the equations for optimal tax on debt and the optimal tax on equity that Chang just showed us follows precisely this structure. So Chang has one term that's essentially this externality kernel that is the same for debt and equity. And then for equity, he has the state contingent payoff of the equity. And for debt, this would just be essentially a unit payoff because it's the same across all states of nature. Now, I'll show you just as an example how in one of these papers that introduce this externality kernel, we can express the optimal the tax and the magnitude of externalities for different types of financial liabilities. So this is from a 2018 paper of mine. And you can see that if we have this kind of complete market setup, we can express optimal taxes or externalities not only for debt and equity, but essentially for any state contingent security. What we can see, just as what Chang told us, the magnitude of the externality or the optimal tax on foreign currency debt is much greater than here. This was for Indonesia, so I have rupiah debt for local currency or for equity investments. So in this case, the optimal tax and externality for foreign currency debt is essentially 5 times the magnitude of an equity investment. So in the paper that Chang presented, we essentially have the same finding that foreign currency denominated debt delivers much greater externalities and requires much greater taxes. Now, let me spend perhaps one slide on the empirical findings that Chang presented. So Chang presented 3 very, how should I say, convincing and in some sense extremely reasonable facts on which he based the analysis of the rest of the paper. The first fact was that greater institutional quality increases the share of equity financing. I think that's it makes a lot of common sense. The second fact, if we have more equity financing, because it gives us greater insurance, it reduces our crisis probability. And the third fact, if we have greater institutional quality, we also need to use less capital controls. So that would mirror this finding that equity provides us with more insurance and also requires a much lower use of capital controls. So I had 2 quick comments on these facts. I wonder if much of the variation that is identified here is driven by advanced economies versus emerging market or developing economies. And I wonder if there is also a similar distinction going on within each category of countries. Because I guess if it was only the variation between advanced countries and emerging economies, we probably wouldn't be quite as surprised that advanced countries have more equity financing, have lower crises, and have lower capital controls. So it would be good to know if that's what drives the result, or if the result is even more general than that. Another kind of small comment, I also thought that expressing equity financing as a fraction of GDP would give us a better indicator of how much insurance a country has, rather than equity financing as a share of total external liabilities, because it's essentially our output volatility that we want to insure ourselves against. So that's why I thought GDP in the denominator may be the best variable. Now, turning to what I believe the main contribution of the paper is, and I think I would suggest that you sell specifically that model of capital structure as the main contribution, because I think that's really what distinguishes your paper from the existing literature. So this model of capital structure features essentially a role style moral hazard problem, which gives rise to a moral hazard cost that is linear in the amount of debt or equity raised. Now, as Chang has presented, the moral hazard problem is set up for both debt and equity, and is then assumed away for the debt, but a collateral constraint on debt is imposed. So I think since this is really the center of the contribution of the paper, perhaps it would be cleanest to derive both the equity moral hazard problem and the collateral constraint on debt from the same micro foundations, from essentially a common moral hazard problem, because I think that would make the problem the most elegant. And I think it could be done. I think it shouldn't be too difficult based on the existing model that the authors have. And I think you could essentially obtain essentially greater generality and greater elegance in precisely the area where your main contribution lies. So that would be
2 minutes.
2 minutes, perfect. That would be my main recommendation. One more observation on this trade-off between debt versus equity. So as we said, the moral hazard problem is linear in the amount raised. So it essentially gives rise to an iceberg cost of equity. There is this fraction of equity that simply melts away due to moral hazard. And what that implies is that the trade-off between debt versus equity is essentially our classic return versus greater return versus greater insurance trade-off that we always face in portfolio problems. And greater institutional quality allows for more insurance. Now, a kind of smaller comment that is more technical and that really does not change the big picture of the paper at all. But in propositions 4 and 6, the competitive equilibrium and also the constrained planners equilibrium find that there is only debt if this iceberg cost from equity is too high. So that makes a lot of sense. If the discount of equity is too large, then we won't use it. perhaps it would be interesting to describe in a little more detail how this threshold for data depends on the fundamental parameters, including the tightness of the borrowing constraint. Because you're still going to want to trade off debt versus equity. And if you have a very tight borrowing constraint, you want to rely a little bit more on equity because it gives you at least some financing to smooth your consumption if you're very poor in the initial period. Otherwise, if data is not too high, there will be debt and equity. And then in the proposition, there is a third bullet point that talks about the case of equity only. But from my understanding of the result, this is actually unlikely unless the iceberg cost is really zero or negative. Because otherwise, we know that if the iceberg cost is tiny, the benefit of the last unit of insurance before you have full insurance is second order, and it would always be worth to save the iceberg cost. So I think the case that you have an equity share of 1 and absolutely no debt, that is probably just a degenerate knife edge case. So let me just jump back to my summary slide. I think the paper provides a very nice theory of the country's external capital structure. And that's where I would focus all my energy in the paper and what I would really sell as the main contribution. And I strongly recommend to everybody to read this paper. It gives us a very nice insight on how endogenizing the capital structure interacts with the motive for imposing capital controls. Thank you.
Thank you, Anton. I think we have a clarification question from Stephen, if I'm not mistaken. Stephen, do you want to go ahead?
Yeah, just a quick question on how the probability of crisis is measured. Is it ex ante or ex post measure?
Okay. Thank you, Anton, and thank you, Steve. Let me come to the Steve's question. So, the measure of a probability crisis is exposed. The systemic banking crisis is Lane's data set, Valencia's data set, and Southern Stop's crisis, I think, is Mendoza and Korinek's annual review of economics, annual review of financial economics paper. In that paper, they identify the Southern Stop crisis, but they are both ex-post events. And Anton, thank you for your insightful comments. I actually continue to learn from you even after graduation. And these comments are very constructive. I need to think about more on that. I want to just add one comment on your questions, which is on the empirical facts, whether this data captures whether advanced versus emerging markets variation or within group variations. So we indeed show some sample test by just running the regression, focusing on emerging market economies. Indeed, you can also see the institutional quality matters for the equity shares. So I would say this captures both, between country group and within country group variation. Yeah. So I like your comments on the more hazard setup. We just need to work more on that. Thank you.
Thank you, Chang. Questions from the audience or fellow panelists? Let me break the ice. I have one that is generally is an unfair question, but maybe you have seen papers that look at the reverse order of causation. So the impact that capital account liberalization can have on the quality of the institution through increased competition among the banking sector or forcing stock exchange to adopt state-of-the-art regulation and so on and so forth. I understand that is outside the purview of your empirical work, and it's very interesting looking in one direction, but I wonder whether you have thoughts on the possible reverse chain.
Yes, thank you, Alexandra. That's an excellent point. So you are touching upon the reverse causality issue, right? So we actually in the empirical setting, which I didn't show there, is that to run an IV regression by instrumenting the institutional quality using the asimoglos IV, which is using the mortality rate for different countries to proxy for the institutional quality measure. And the IV regression basically confirms our finding, which is institutional quality causally lead to the equity shares in countries. But I agree with you that there might be cases when countries liberalize their capital account that can potentially change the institutional quality in the data. But for that, based on our regression, we don't find the case for reverse causality.
Yeah, so Chang, I really enjoyed the paper too. Can I ask a question about Alexander?
Sure.
Yeah. So, yes, I was thinking, so if you get that result, and also if you think about Anton's discussion, which I thought was great, might there be implications for the volatility of current account imbalances between more and higher and lower moral hazard countries? Because you should see the case that if it's cheaper to externally raise capital, then you should be doing more of it. And so you should be better insured. And you should also see more volatile flows if you are, less moral hazard. But I'm not sure that's how current account imbalances look in the data. So I was wondering what you might have to say about that. And maybe it's because there are crises that manifest themselves, and that's a completely different part of the story.
Right. Thanks, Mark. That's a great comment. So here in our current setting, we just focus on the rare volatility event, which is a financial crisis. Of course, I think you are referring to the business cycle fluctuation of volatility of current account, whether that have a correlation with institutional quality in the data and in the model. In the model, if we integrate the crisis, it's possibly correlated with volatility of current account. In the model can generate that. But in the data, I'm not sure. I need to run a regression to test whether that's true or not. Thank you. That's a good comment.
Other question or comments? So if there are no further comments or questions, I think, Elaine, I pass it back to you for giving us instruction how we move forward with the program.
Well, thank you. Those are really phenomenal presentations, discussions, and very good shares. There's I'm sure you all have the ABFER conference, but after the luncheon, then there's this next International Macro Money and Banking at it's everyone's different time frame. The papers start at 3 p.m. in Singapore time, and we'll have a couple more. And that'll be that for this afternoon for today. And then we will reconvene again with a couple more programs, as well as the joint program with SEBRA. So keep your eye on the program. And thank you all very much. It was really, really good.